Well, let's first up talk about taxes. Usually, the 31st of March is the last date to make any tax-saving investments for the fiscal year gone by. So 31st March 2021 will be the last date to make your investments that will help you cutting down your tax bill for FY21. Remember, last year, of course, the FM had given an extension till the 31st of July, but it's not going to happen this year. Last year was a one-off on account of the pandemic, but this year, it's out of the question. In fact, it never happens. Only last year was an exception. It's not like your return filing date where there are extensions granted. So 31st March is the hard stop, which means that you have, 25 odd days left to plan your tax saving investments. So how should you go about it? And now, of course, there's also another question: who should go about it? Because now we have two different kinds of tax regimes. One that does not necessitate the need to make these tax saving investments. So let's discuss all of this with Karan Batra. He's the founder and CEO with charteredclub.com. Karan, many thanks for joining us today on the Money Show. So just start with Karan. We've discussed this topic very often in the past. How exactly, what are the instruments available, the sections available out there with which an individual earning more than 5 lakh rupees of income or 7 lakh rupees of income can save on taxes?
Hi, Mubina. Good evening, and thanks for the invite. So, the deductions which are available are the usual ones. That is, under Section 80C, a person can invest up to 1.5 lakh rupees. And these mainly cover your PPF, ELSS. And apart from that, there's health insurance, which is covered under Section 80D. So, a non-senior citizen can claim deduction of 25,000 rupees, and a senior citizen can claim deduction of 50,000 rupees. And apart from that, there's NPS, in which a person can claim additional 50,000 rupees of deduction. And apart from that, there's interest on home loan, for which a person can claim 2 lakh rupees of deduction every year.
All right. Okay. So if you had to, pick the easiest, instrument out there, the easiest to understand as well for our viewers, easiest to manage, easiest to liquidate, which one would you pick?
So health insurance is one I would pick. Apart from that, under 80C, I would pick 3. That is, one is life insurance premium, second is PPF, and if a person is comfortable with ELSS, you should opt for ELSS as
well. All right. Which, many of these tax saving investments have lock-ins, which means that once an individual puts their money in, they will not be able to take it out, in the next few months or maybe even the next year. So which are these instruments, that our viewers as well should be aware of? And let's say if, they can't afford to have their money locked in for too long, then what would you recommend?
See, all of these investments, all of them have a lock-in. So the least lock-in is in ELSS, which is 3 years. PPF has a higher thing. The home that you're purchasing, even you cannot sell it. So the minimum is 3 years, a lock-in. An average lock-in is around 5 years with most of the instruments. If a person cannot have money to ensure lock-in, or he does not have sufficient liquidity, then maybe he should opt for the new regime, wherein he is not required to make any investments. So the new regime is basically for people who don't have liquidity to make investments or who don't want their money locked up. So in such cases, the new regime is better. For people who can have lock-ins, who have liquidity, they should opt for the previous regime. So previous regime is good for people who can ensure a lock-in or can have sufficient liquidity. So I have some clients, so the daughter is getting married next year. So they say they cannot do investments. So such people, they're opting for the new regime, where you're not required to make any investments and there's no lock-in.
Okay, understood. Now let's talk about this new gift given to us by FM Sitharaman in last year's budget, which would obviously be applicable from the financial year April 2020 to March 2021, and that is a new tax regime that essentially involves paying a lower tax rate. So in such a situation then, how would you do they need to really be bothered with this entire exercise that we are talking about?
No. So people opting for the newer tax regime, they don't have to make all these investments. However, there are certain things which people in the new tax regime can also claim. So interest on home loan is one thing, and your leave encashment is another thing. So most of the people, they don't have to worry about it. It's only those small deductions which would be available for people in the new regime as well.
All right. Okay. So it may not necessarily be, I mean, you're saving yourself from all of that tax saving hassle as well, investment hassle as well. However, Karan, I think what should these individuals look at when deciding whether they should opt for the new regime or old regime? Prima facie, it looks very easy, right, to opt for the new regime because the rates are automatically lower. But what would they be missing out on? What would be the key disadvantage of that, which may not be so easily visible just by looking at the numbers?
See, the tax rates are certainly lower, but then we lose out on the tax deductions. So something that person should look at is, does he have the sufficient liquidity to make these investments? Number one. Number two, is he comfortable with the lock-in? So if they are okay with these quacks, go for the previous regime, else go in the new regime. In fact, in the new regime as well, a salaried taxpayer can keep on changing his regime every year. So he may opt for the new regime this year, opt for the previous regime in the previous year or in the next year. So they can switch in each year. However, a self-employed person, once he shifts to the new regime, then he cannot go back to the previous regime. So a self-employed person will have to take this into account as well, that once he opts for the new regime, he cannot go back to the previous regime.
Okay, so business people, professionals, self-employed people, basically, once they opt for a particular regime, they cannot keep switching. But if you are salaried, then you have the option to choose between 2 financial years. So let's say in FY21, you decide that, okay, maybe I'll pay a lower rate of interest, perhaps because, you may be a little short on cash, and you don't really have the cash right now to put into any tax saving instrument, then yes, maybe you could go for the old tax regime, the new tax regime, which will then let you pay a lower tax rate. However, if you are, and then next year, of course, you can switch back to the old tax regime if you want to continue using PPFs and LIC and health insurance as a tax exemption or a tax deduction. All right. I want to talk about one particular head, and that's capital gains. Karan, in this last 1 year, the market has rallied significantly. And now, as we know, a long-term capital gain, which is when you invest and hold a listed security for a year or more than a year, it is considered as long-term, is taxable at 10%. Now, in this market rally, many may have, booked some profit as well, and now it's going to be taxed. So let's understand in both cases. Let's say if a person has not yet booked their profits, and B, but they do want to, and B, somebody who's already booked their profits. For somebody who has not yet booked it, they still have some flexibility on how they can go about trimming their tax bill to the bare minimum. What do you recommend they do?
See, these long-term capital gains on shares and mutual funds, they are taxable at 10%. However, every year there is a exemption limit of 1 lakh rupees. So up to 1 lakh rupees, it is exempt. So if somebody has not booked it but is planning to book it, then maybe he can book it up to say 1 lakh rupees because that is tax exempt. If he wants to book higher amount, he can book higher amount as well. But up to 1 lakh rupees, everyone can book. And maybe if they want, they can reinvest later as well. Number one. Number two, there is an exemption also available wherein if a person sells shares or mutual funds and he buys a residential house property, then the entire gains are tax exempt. So there's no maximum limit. So whether that's 1 crore or 5 crore or 10 crore rupees. So if you sell shares and mutual funds, which are held for more than 1 year, and you invest in a residential house property, then your entire capital gains are tax exempt. And here I'm referring to section 54F.
Okay, understood. So that's about capital gains and how you can go about, managing the tax bill that will come around. Karan, I'm going to ask you a bit more of a holistic question now, something to do with financial planning as well. Many times when people look at tax planning, they also look at it as a part of financial planning. They want a product that will give them a good return as well. So what's your view on this entire exercise? If you could just give us a more holistic approach when an individual is picking a tax saving instrument, what are the key things he or she should look at?
See, tax planning and financial planning should always go hand in hand. We should never buy something just for the purpose of tax saving, which does not fit in our financial goals. So yes, tax planning and financial planning should go hand in hand. And one thing which I recommend to everyone is PPF. That's a fixed income earning instrument. Earns a better return than FD. You can claim deduction under Section 80C, and even the interest earned is tax free. So PPF is something that should be a part of everyone's portfolio. Apart from that, ELSS is also a good option, wherein you're riding the India growth story. So if you're investing for the long term, the returns are also good, and is also you can claim deduction under Section 80C for ELSS as well. So these are the two ones.
Okay, well, great. There you have it. Everything you need to know about planning your taxes for this fiscal year 2020-2021. Some options given: PPF, LIC, health insurance, of course, which Karan listed as, I think, the best way. And given the fact that we've just come out of a pandemic, or actually for most of us, we're still in the midst of a pandemic. Let's not forget that COVID cases are still very much there in India, and we have to adopt precautions. A health insurance, of course, is the first thing that we can do sitting at home to protect our family. And guess what? You also get that Section 80D benefit for you, for your family, for your senior citizen parents as well, who may be dependent on you. So that's definitely the best way to be able to get financial security, as well as, of course, a tax saving boost or an incentive as well. ELSS, PPF, ELSS with only a 3-year lock-in, PPF with a 5-year lock-in. By the way, Karan, I want to get in your take on this net outflows that we've been seeing in ELSS. Usually from December onwards, we start seeing inflows into ELSS schemes, but now we've started seeing net outflows even in December. In general, mutual funds are seeing net outflows, but what do you think is the reason that still people are not putting in their money in ELSS? Jan, maybe yes, it's increased a little, but till December, is it losing popularity?
No, it is not losing popularity. It is another asset that is gaining popularity, and that is residential real estate. So yesterday only I was sitting with somebody, and he was saying that residential real estate is picking up very fast, and that is what the number was also saying. So whenever a person buys real estate, he liquidates his fixed deposits and redeems some money from the mutual funds, because real estate in India requires a huge chunk of money. So one reason why there is some outflow from mutual funds and ELSS is people are investing in real estate, number one. Number two, there are some people who are not comfortable with the current valuations. So maybe they are booking some profits. So these are the primary two reasons. But ELSS as a product is still very good. People are gung-ho about it, and I would recommend it to everyone.
All right, excellent. So, that's just a quick take on ELSS as well. Well, I think let's time to take on board some questions and queries as well that we've received from our viewers. Remember, folks, if you'd like to connect with us, you'd like to ask any questions to Karan, you can write in. Our email address it'll appear on the top of your screens as well, themoneyshow@etnow.tv. So, do write in whatever questions that you may have, and Karan will get them answered. We'll be monitoring our email address as well. Okay, let's take on board our first question. Ayan Chattaraj writes in saying, between PPF and NPS, which option should I choose for retirement corpus building and tax saving? You just said, Karan, about how financial planning and tax planning should go hand in hand. You should not, pick a product for tax saving just because it looks attractive, or, it should fit into your financial portfolio. And I think that's what Ayan as well is trying to do. He's looking at it as tax saving and retirement corpus. So yeah, what would you recommend between the two?
See, both of them have their pros and cons. And so PPF is basically an instrument which is to encourage savings, whereas NPS is primarily for retirement planning. So that's a core retirement planning product, number one. Number two, when we talk about retirement planning, so retirement planning is a long-term goal, say 15 years away, 20 years away, 25 years away. So for such long terms, NPS may deliver a better return because PPF, the returns are fixed. In NPS, these are market linked, and market linked returns over a long period of time usually give better returns because the benefit of compounding also kicks in. So NPS may be a better product in this case.
Okay. So, PPF actually as a product inherently its characteristic is to promote the habit of savings among individuals. That's the reason why in fact there's a lock-in also of 15 years. You can't withdraw your money for 15 years over there. So in a way it's a good way to encourage the habit of savings. And with NPS of course you have the whole power of compounding bit that kicks in, which will benefit viewers. So hence especially from a point of view of retirement, which is by the way the stated goal of a national pension scheme, NPS is a better option. All right, moving on. Pranjal Barola writes in saying, I've been filing my ITR for my business under section 44AD for the last 6 years. If I opt out of presumptive taxation this financial year, am I liable to get my books audited even if my turnover is less than rupees 1 crore? Karan, for the benefit of all of our viewers, especially businessmen, businesswomen, small business owners, if you could just explain what are the provisions of section 44AD, how do they benefit, these small business owners, and of course, if you could specifically help out Pranjal as well with the query.
See, basically what happens is all business people, they pay taxes, they pay income taxes only on the profits part, not on the entire sales part. Now, how do we arrive at the profit? Sales minus expenses is equal to profit. So this is the normal mechanism. And in this mechanism, what happens is a person is required to keep a track of all the expenses, like his mobile bills, petrol bills, the depreciation on assets, and salaries paid. So a lot of invoicing is there. You have to do a lot of paperwork. You have to maintain profit and loss account. You have to maintain P&L, balance sheet. So there's a lot of headache that goes into preparing all this. So for small business owners, the government has tried to simplify the taxation regime, wherein they said you don't have to get into all these hassles. Every business owner knows his approximate profit. So government says, don't prepare all these, just pay tax on your approximate profit, which is called presumptive income. And they say disclose minimum 8% in case of payments received by cash, and disclose minimum 6% in case of payments received by the online mechanism and banking channels. So this is the scheme of presumptive taxation, which is to simplify the manner of computation of income. And in the past 5 years, this has gained a lot of popularity. So year after year, we see the number of returns that are filed. So last year, if I tell you, more than 1.5 crore people filed their returns using the presumptive tax mechanism. So presumptive tax mechanism is good. It simplifies taxation. There's lesser hassle, no books of accounts required. That is the concept of presumptive taxation. Now, in this case, the user is asking, what if he leaves the scheme of presumptive taxation? Then is he required to get the audit done? So yes, a new clause was recently inserted, which was inserted a couple of years back, wherein they said that if a person leaves the scheme of presumptive taxation, he cannot again enter the presumptive taxation scheme for the next 5 years, number one. Number two, for the next 5 years, he would be required to get his audit done irrespective of the turnover. So this is the scheme of presumptive taxation. And if you opt out for it, then you will be required to get your audit done.
Okay, so regardless of whatever the turnover is, you will then have to get your books of accounts audited. That's something that you could look at it as a drawback of opting for the first time for the presumptive scheme. And of course, once you opt out of it, then there's no going back, at least for the next 5 years. So that's advice for Pranjal, or rather information coming in for Pranjal. Okay, one more question then. Santu Mondal writes, person in a lower tax bracket should not buy debt funds except PF, PPF, bank and post office schemes. Person in the 30% tax bracket should invest in overnight funds and liquid funds, with the exception of 5% extra return, with the expectation rather of extra return compared to a bank FD. I think that's what he's trying to say. Is his assessment correct? His point is right that when you look at fixed income investments, you should consider your tax bracket, because then, net of taxes, the return falls significantly. However, Karan, what do you think of what Santu has to say? Is he right in what he is saying that, how different tax bracket people should invest in different, fixed income schemes?
Yes, it is right. So tax planning, whenever we invest, tax planning should be considered. So maybe what he's trying to say is on the interest earned on FD, a person is paying 30% tax, whereas on debt funds, if a person holds more than 3 years, the rate of tax is 20%. So sometimes people go by this logic and opt for debt funds instead of FDs. However, I would like to apprise him and all the viewers that the returns on debt funds are also a function of the interest rates. So if the interest rate goes down, the debt funds value go up. And if the interest rates go up, debt funds value go down. So the question asked by the user is not so simple to be generalized. And it depends on a case-to-case basis. And they should consult their financial advisor or do all their calculations before opting for it. This is not only a taxation impact, but the prices of debt funds change with the change in interest rates.
Okay, so it's a very larger issue as such, but Karan has, sort of explained it for the benefit of our viewers. Well, I think on that note, we will have to end our Q&A segment. If you've sent in your question and we've not been able to answer it, well, we will be back with more, such sessions with Karan. So keep writing into us on the Money Show at etnow.tv and we'll get them answered. And thanks, Karan, as well for joining us today and, helping our viewers as well out with their questions.
Thank you.
Okay, well, moving on, all employees can breathe a sigh of relief because retirement fund body EPFO, the Employees Provident Fund Organization, has decided to keep interest rates unchanged at 8.5% on provident fund deposits for the current financial year. Remember that the EPFO has about 5 crore active subscribers. These are all usually employees with the private sector. Now, this interest rate is going to be notified in the government gazette, following which the EPFO would credit the rate of interest into the subscriber's account. So, it's the second year that the interest rate will be 8.5%. It's still much better than, what you get from your other small savings schemes and FDs like PPF and NSE, etc. 8.5% is definitely good given, the kind of interest rate environment in general we are in. Let's not forget that contribution to the provident fund by your employer and employee also is eligible for a tax deduction. So some good news coming in for individuals, employees out there, private sector employees actually. And on that note, we will finally take a very short break on the show. Don't go anywhere.